We've talked about the balance sheet before, but now we're getting into many of the details that we haven't already discussed. We're going to go into a lot of details about the balance sheet, so please take this document off of Blackboard called Video Notes Template and write your notes along with me. You may want to have this playing on a separate screen or on your phone so you can use your computer to take these notes down that are very important for us to remember. The balance sheet, to start off, the balance sheet is also referred to as the statement of financial position. And that's because it means where the company stands at one moment in time. Remember, the balance sheet is our only financial statement that's exactly one point in time rather than covering a period of time. As we know, the balance sheet is comprised of assets, liabilities, and equity. I like to think of these three components separated into two main segments: assets, what the company is using to run the business, and liabilities and equity, how the company is financing its assets. So what are the main uses for the balance sheet? Well, one of them, of course, is listed out here on the PowerPoint slide. Just like the income statement, the balance sheet is used in conjunction with the income statement, helping the investors and any other users predict the amounts, timing, and uncertainty of the company's future cash flows. The balance sheet is also used, particularly this liabilities and equity section, is also used to help investors or any other financial users, such as creditors, determine or assess a company's ability to pay its short-term debts. And that ability to pay your short-term bills as they become due is called liquidity. That's, of course, very important because if a company can't pay off its short-term bills, then it's going to end up needing to raise cash, perhaps by selling off its plant, property, and equipment, in which case it won't be able to operate for too much longer. The balance sheet is also used to assess a company's ability to pay its long-term debts, and that is called solvency. Of course, if a company can't pay its short-term or its long-term debts as they become due, the company is going to go into bankruptcy. We've talked about current assets before, and when we did, we said that current assets are generally those assets that are used up in about a year. But the GAAP's definition of current assets is cash and other assets that a company expects to convert into cash or sell or consume, use up. So the company is going to, it has cash, it has accounts receivable that will be converted into cash, inventories will be converted into cash, inventory will be sold, and prepaids and supplies will be consumed in the business, either in, it's not technically 1 year, but it's technically 1 year or the operating cycle, whichever is longer. So what is the operating cycle? We can see a figure of the operating cycle here, where a company starts off with cash and an idea. It takes some of that cash and purchases raw materials or finished goods inventory. If it's manufacturing those goods, it puts those goods through the manufacturing process and turns them into finished goods. It sells those goods to customers. Some of those sales are probably on credit, some in cash. It then collects all the cash from the customers, and that operating cycle repeats. So the operating cycle is defined as the period of time between purchasing raw materials and supplies, converting them to inventory, selling them to customers, and collecting the cash from those customers. Here in this PowerPoint slide, we see the main categories of current assets, and they are listed in this order, this specific order. Cash first, of course, because that's the most liquid, but we don't just say cash. Cash also includes cash equivalents. So let's define what cash equivalents are. These are not strictly your checking or savings account. They are very, very liquid investments that the company might keep that can easily and without much risk be turned into cash at a moment's notice. They generally mature within about 3 months. And the items, some examples of what we're talking about, are very short-term certificates of deposits, very short-term treasury bills, and if the company invests in commercial paper, that would be considered a cash equivalent. Again, it has to be very short-term commercial paper. One thing we want to remember about cash is that there may be a restriction on cash. So the company might report what's called restricted cash. Why would cash be restricted? It's either by some sort of a contract, perhaps a loan or maybe a lease agreement, and that lender is saying, we want to make sure the company's not spending down all of its cash. It's going to have some cash available to repay us when due. And we call that restricted cash. The restriction could also be placed by the board of directors that are overseeing the company. If that cash is restricted for a long period of time, then that restricted cash would be reported separately, not in current assets, but separately as restricted cash, perhaps in the long-term section. So restricted cash may need to be classified as a non-current asset if it's restricted for more than 1 year, or the operating cycle, of course. Okay, so that is the first current asset account. The next current asset count that we really haven't talked about at all this semester is called short-term investments. And these are generally debt and or equity investments. So investments in stocks and bonds. It could also be notes receivable. But again, they have to be very short-term. Understanding how to classify debt and equity investments. Not all debt and equity investments are classified as short-term investments. Only some are. And to understand which ones means we have to understand a little bit about accounting for financial instruments. Debt and equity securities that are classified as trading, meaning management holds these debt and equity securities with a specific goal of selling them to capture short-term price movements. So they're going to be sold generally within about a year, oftentimes much, much faster. When management has that intent, so every time management is purchasing debt and equity securities, they need to determine what is our strategy here? What is our intent? And if that intent is for trading or quick sales, they are always recorded as short-term investments. So you might be wondering, well, what are the other categories? Debt and equity and investment securities that are classified as another classification that we call available for sale. These are the positions that we're not planning on actively trading. We're not planning on holding them for a very long period of time. We're not quite sure what we're going to do. They're there if we want to. So these are sometimes classified as short-term investments, or I should say reported. They're sometimes reported as short-term investments. So when? Well, when management decides, we think there's a good chance they're available for sale and there's a reasonable enough chance that these are going to be sold within the next year. It's completely based on management's intent as short-term investments. As you can imagine, we're going to see short-term investments, or we should say investments, also being reported in the non-current section. And we will see this here under this long-term investments category. What else do we need to know about this? So debt securities, there's one other classification. One is trading, one is available for sale. Let me highlight these terms. We're going to go through these in a lot more detail in Intermediate 2 when we spend a few weeks talking about debt and equity securities. Debt securities, remember we're thinking bonds are the most common type of debt security, that are classified as held to maturity. That's the third possible classification. Well, the company is planning to do just that, holds a bond until it matures, in which case, if you're going to hold it to maturity, then it should almost all situations be reported as a long-term investment. Remember, bonds often have 10, 15, 20 or more maturity periods. So they are not considered short-term investments, except, now there's one major exception here. So think about that 20-year bond. For its first 19 years, it's going to be listed as a long-term investment. But once that 19-year, that bond is in its 19th year, it's due within 1 year, right? So then it gets reclassified out of long-term and into short-term. So except during the last year before it matures, before they mature. And you'll notice in this first 2 bullet points, we're talking about debt and equity securities, and here we say simply debt securities. If you're wondering why aren't we listing out equity securities here, equity securities do not have a maturity date. They are always, they never have a maturity date, right? Corporations, it's just the death of the company is when that equity security no longer has value. Okay, so debt and equity securities classified as trading, these are always reported on the balance sheet at fair value, and we need to know this. Debt and equity securities that are classified as available for sale are also always reported on the balance sheet at fair value. Debt securities that are classified as held to maturity, I'm just going to write here, rather than discussing how they're accounted for, let's just say not reported at fair value. We don't care about the market movements in debt securities if they're going to be held until they mature. Okay, so continuing on down with our current assets, the next one is that we have here is receivables. Of course, this relates to accounts receivable and notes receivable. Accounts receivable are also referred to as trade receivables. This is generally when we sell goods to customers on credit, part of our daily operations. There's no formal agreements. And remember that when we sell on credit, there's always a chance that our customers are not going to pay us back. So accounts receivable are always reported net of the allowance for uncollectible or allowance for doubtful accounts. Notes receivable are considered short-term if they mature within 1 year of the balance sheet date. And we might see something called non-trade receivables. So if trade receivables are those receivables that arise from selling goods to customers on credit, how else can we have a how else can we have a receivable that's non-trade? Could be, for example, loans made to employees. And we still expect to receive the cash, but not from our customers. Next, we have inventories. There's not a whole lot we need to add about inventories. We know that the company is going to disclose in the footnotes their inventory valuation method, whether it's specific identification, FIFO, LIFO, or weighted average. The only other thing we'll add here is that may be broken down when it's reported on the balance sheet into raw materials, its stage of completion, raw materials, work in process, and finished goods. If the company decides it wants to report in that manner, that level of detail. Okay, our last current asset, and again, remember we do report these in this order: cash, short-term investments, receivables, inventories, and then prepaid expenses, otherwise known as prepaid assets. We have already covered what we're talking about with prepaid expenses. This is the, you pay in advance of using short-term assets such as insurance, prepaid rent, or prepaid taxes. Okay, so if I scroll down these slides here, we've become familiar with most of these bullet points. And here we have a summary. And this is what a balance sheet would look like if a company is separately reporting accounts for in every one of these 5 categories here. Next, we're going to move on to the long-term investments section of the balance sheet. We have several categories within the long-term investment. Think about what an investment is. You're trying to earn, your main goal with an investment is to earn some sort of a return. Dividend return, interest return, or capital gains, a change in the market value that moves in our favor. That is not always based on stocks. So we have several different types of long-term investments. The categories of long-term investments that we want to be familiar with. One is the securities, the ones that are most obvious. Bonds, common stock. Now, we're not limited to these items that we're writing down, but these are some of the most frequent. And long-term notes. In this case, it would be notes receivable, of course, not notes payable, the other side of the company who's doing the lending and earning interest revenue. But that's not the only type of long-term investment that a company can have. A second type is plant, property, and equipment. You might be thinking this is crazy right now. And why is it listed below here as a separate classification under the long-term assets or the non-current asset section? This isn't just plant, property, and equipment. This is PP&E that is not in use in operations. PP&E not currently used in operations. So if a company is holding on to buildings, equipment, land, but it's not using it to conduct its operations, to manufacture goods, to sell those goods to customers, then why would it hold on to it? It would hold on to it because it would want to, it would be held for future use or held for speculation, meaning we're going to hold on to this. We're not going to sell it right now. We think the price is going to increase in the future, and therefore we're going to capture a gain on it in the future. So doesn't that sound just like a bond or a share of stock? And that's why PP&E not currently used in operations is classified under the long-term investments section. Of course, we can see here we're separately classifying the PP&E that is used in operations in its own separate classification outside of long-term investments. What else might we see in the long-term investment sections? Investments set aside in special funds. So this means the company has put aside some cash for specific reasons. One of these investments set aside, and we do need to remember each one of these items, how that they are classified as long-term investments. The first one, sinking funds, is typically set up when a company has a large outflow of cash coming up, such as when those 20-year bonds that the company now has issued rather than invested in, when the company's bonds payable are getting close to due, it needs to repay a whole lot of cash, all of that principal back. Some bonds require the company to put away a sinking fund throughout the life of the bond. That's where the company is setting aside cash in reserves to ensure that it has adequate cash at the date that a large cash outlay is coming, such as repaying the bond's principal. Another type of investment is called pension funds. These are when the company has promised its retirees pension benefits, and all along the time that the employee is working, the company should be reserving or stashing away some cash to have for that payout for when that employee does retire. Another type is called a plant expansion fund, and that's exactly what it sounds like when a company, kind of like what we said with a sinking fund, when a company has to pay off a bond, it might stash away some cash. When a company is planning on acquiring a lot more plant, property, and equipment, it might, because that's a big cash outlay, might be saving up the cash in advance. The last item of a special fund that we're going to discuss, that we're going to write down, is called the cash surrender value of life insurance. And that is also considered an investment in a special fund. Okay, one more subcategory within the long-term investments section, and that is investments in non-consolidated subsidiaries. This is also known as investments in affiliated companies. So investments in non-consolidated subsidiaries, the term non-consolidated subsidiaries should sound familiar. Remember on that income statement, if the company owns more than 50% of the common stock of a subsidiary, it consolidates 100% of the revenues and expenses of that subsidiary. And then it subtracts out the portion of the income that it does not own, the minority portion, in one line at the bottom of the income statement. Subtract out income attributable to the non-consolidated, to the non-controlling interests. Now what we're saying is These are the investments which we do not have control over. So the company's common stock investments that we have, where we own less than or equal to 50%, we do not consolidate. So we need to report that investment on the assets section, and we report it specifically here in the long-term investments. Separate, this is if we own more than 20%. I'll write that down. If the company owns more than 20% and less than about 50% of the common stock in the subsidiary. If it owns less than 20%, it would just be listed as a common stock investment, the regular type. And if it owns between 20 and 50%, then it shows it in the line called investment in non-consolidated subsidiaries. And of course, if it owns more than 50%, then it consolidates all of the financials. Those are the four long-term investment categories. Our next section, so if we come back up here, our next section is the plant, property, and equipment section. We're familiar with the plant, property, and equipment section. We've talked about this before. Remember the plant, property, and equipment. Now we know the caveat that this stuff must be used in operations. If it's not being used in operations, it's separately reported under the long-term investments section. Okay, so we are talking about buildings and equipment. Of course, net of accumulated depreciation. Land, which is never depreciated. There could be other items that we see in plant, property, and equipment, such as natural resources. Things like oil, timber. And these would be reported net of we don't call it accumulated depreciation, we call it net of depletion. The using up of a natural resource is called depletion. And that's everything we need to know about the plant, property, and equipment section of the long-term assets section of the balance sheet. Next is intangible assets. Intangible assets are those, they have a future benefit, but they lack physical existence, and they're not financial instruments. Some of these are, some intangible assets are what we called amortized. Instead of calling it depreciated, we call it amortized, allocating the cost over the useful life. And others are not. We're going to talk about those specific rules as our last topic in Intermediate 1 at the end of the semester. We want to be familiar. We don't have to memorize the exact details of the different types of intangible assets, but when we see these account names, we need to know that they are intangible assets. The first is goodwill, and I'm not going to spend time talking about what goodwill is. There's no simple way to describe goodwill. We'll get into those details towards the end of the semester. Patents, trademarks and trade names, copyrights, and franchises. These four categories here are all legal rights. The company incurs a cost in order to obtain a legal right, and that legal right allows the company to generate revenues and income in the future. Finally, we have the other assets section. And we can see the other assets listed here, some possible accounts that might be reported in the other assets section. Long-term prepaid expenses. These are sometimes referred to as deferred charges. For example, if you pay in advance 3 years of your rent, then that first year would be reported as a current asset, and the 2 subsequent years would be reported in the other assets section. Another option is long-term receivables, long-term notes receivables, as we know, and sometimes we see deferred income taxes. We're going to talk in a lot more detail about deferred taxes in Intermediate 2. So that concludes the asset side of the balance sheet. Here we see our summarized current assets, long-term investments, plant, property, and equipment, intangible assets, and other assets. Next, let's move to the liabilities and owner's equity side of the balance sheet. We added to our definition of current assets, right? Prior to this class, we had said current assets, stuff that's going to be used up in about 1 year. Then we said, well, that's not technically true. Stuff that's going to be kind of used up in 1 year or the operating cycle, whichever is longer. Similarly, we've always said current liabilities are those that we expect to be paid, for the company to pay within about a year. But we have a more specific definition that we want to remember for the current liabilities. Obligations that are expected to be paid through the use of current assets. But remember, if those current assets are really generally held for about a year, then we're going to be paying these off in about a year. Or the creation of other liabilities. And generally it's going to be paid through the use of current assets, and most bills are going to be paid, of course, with cash. So some examples that we are talking about of current liabilities you're already familiar with. I don't think we're adding anything here that you haven't heard about before. Accounts payable, short-term notes, sometimes referred to as short-term debt. Let's see if we have this on a slide here. Accrued liabilities, here we see in this slide accrued compensation. Sometimes accrued liabilities are referred to as accrued expenses. They mean the same thing. Unearned revenue. Remember when we receive cash in advance of providing the goods or services to customers. Some other examples, wages and salaries payable, taxes payable. And then one that we haven't talked about before, but is by its title is pretty self-explanatory, the current portion of long-term debt. Remember we talked about that with the investments. We said that the short-term investments are when we're invested in another company's bonds or another company's debt, in that last year that before they're going to mature, we're going to shift the classification out of long-term and into short-term. Then this is referring to our company's own debt. In that last year, before payment is made, we reclassify long-term debt as short-term, as a current liability. So why does that matter? We'll talk about that in just a moment. Why does this classification between current and long-term matter? We'll talk about that very soon. Some liabilities that will be paid within a year are reported as long-term liabilities. It has only in a certain situation. This occurs when the company expects to, and there's two situations, when the company expects to refinance the debt, so to take out new debt to pay off the existing debt through another long-term issue, or pay off your debt with new long-term debt, or when the company plans to retire the debt or pay back the debt out of non-current assets, meaning that the company is planning on, let's say, selling its equipment in order to pay off the debt. The importance of the current versus non-current classification for both our assets and liabilities is really important because investors want to be able to assess how much cash does this company have, or short-term assets that the company can sell for cash. How does that cash and other current assets compare to the amount of short-term bills? And this is called working capital. So this is a really important term. Working capital is the difference between current assets and current liabilities. So it's just a dollar amount that says how much do you have, or can you convert into cash, and how does that compare to how much you owe? So if working capital is negative, we can say that that's a sign of concern for the company and its ability to pay off its short-term bills, or in other words, that the company might have some issues with its liquidity. So working capital is a measure of liquidity. Next, we have our long-term liabilities. Let's define these. Long-term liabilities are obligations that are not reasonably expected to be paid or liquidated within the normal operating cycle. Okay, so some examples of long-term liabilities: bonds payable, long-term notes payable, lease obligations if a company enters into lease for a facility, rather than actually buying the plant, property, and equipment, it might lease the plant, property, and equipment, in which case it owes a certain amount, like a rental payment, rental obligation. Pension obligations. This is the amount that is owed to the employees at retirement because they've provided the services that that they said they would for us in order to give them this pension benefit. Deferred income tax liabilities, which again we'll talk about in a lot of detail in Intermediate 2. And then finally, product warranties and contingencies. Contingencies are those amounts that we might owe. We think we're likely to have to owe them, but we're not exactly sure, such as perhaps losses in a lawsuit. And that completes our long-term liabilities section. Our next and last section of the balance sheet is, of course, owner's equity. And when we're talking about a corporation, we call it stockholders or shareholders' equity. We've talked already many times, and since Accounting 221, about capital stock. If not capital stocks, but capital stock. If a company only has one type of stock, of course, that's called common stock. A company may choose to issue as an additional type, a special class of stock called preferred stock. And one thing we need to mention here that we haven't discussed so far is that we record the capital stock at par value. Par value is just a completely arbitrary dollar amount that's assigned to a share of stock. It used to have an actual meaning. It wasn't just an arbitrary amount many years ago, but since then most companies have a par value of a penny per share or even less. But the accounting still follows. We separately need to account for the amount that the company receives when they issue the stock above the par value. Even though today this classification between common stock and additional paid in capital is completely arbitrary. No investor cares about this difference. We still have to report these items separately. So the excess amounts paid in over par, or what we call sometimes par is referred to as the stated value per share of stock. So if a company has both common stock and preferred stock, it reports each one of those at par, and then it also has two additional paid in capital accounts, one for the common and one for the preferred stock. So we know that another component of stockholders' equity is retained earnings. Remember, this is the accumulation of all the profits of the company in its entire life, less all of the dividends it's paid out in its entire life. Another way of saying this is the undistributed earnings of the corporation. So keep accumulating these earnings. And what reduces the company's earnings would be the dividends. Okay, companies need to separately disclose any restricted restrictions, or what we call appropriations, just meaning restrictions, on retained earnings. Okay, what else? We said common stock, and we broke that up into its par value and additional paid-in capital and retained earnings. What else could there be? Well, we just recently mentioned that there's an additional account called Accumulated Other Comprehensive Income. And we typically refer to this as AOCI. And this is the cumulative total, or the aggregate amount of other comprehensive income. And remember, what is other comprehensive income? Well, at this point in the semester, all we need to know is that other comprehensive income relates to the unrealized gains and losses on available for sale debt securities. They bypass net income. Instead, they get recorded into an account called other comprehensive income. And at the end of the accounting period, other comprehensive income gets accumulated. The balance gets transferred into accumulated other comprehensive income, or AOCI. Yep, there's more. What else might be listed here? Treasury shares. We haven't really talked about this, treasury stock or treasury shares. We haven't really talked about this at all this semester, but when a company buys its own stock back, buys its own shares or reacquires its own shares out in the market, it separately reports. It doesn't just reduce common stock. So the common stock account, let's say if the company's buying its own shares of common stock back, it doesn't just reduce the common stock account, it separately tracks those reacquired shares. As an account called treasury stock. And really important to note is that treasury stock is a contra equity account. So stockholders' equity accounts carry normal credit balances. Treasury stock carries a normal debit balance. It reduces the amount of stockholders' equity. And there's one more that we don't see terribly frequently, but sometimes we see this: non-controlling interests, sometimes referred to as minority interest. So this does relate to the non-controlling interest that we saw on the income statement. Remember, when a company owns more than 50% of the stock of another company, it is considered to have control, and it consolidates 100% of the revenues and expenses of that subsidiary. Same rules apply for the balance sheet. The company is going to, if it has more than 50% of the common stock of the subsidiary, it combines or consolidates 100% of the assets, 100% of the liabilities of that subsidiary. But it doesn't actually own 100% of the assets, and it doesn't actually it's not obligated to pay off 100% of the liabilities. That portion of the net assets, the assets less the liabilities, that the company does not have ownership in. So if the parent has a 70% interest in a sub, that additional 30% of the net assets minus liabilities, is subtracted out of the stockholders' equity section. So the portion of a subsidiary's equity not owned by the controlling shareholder or the parent company, the non-controlling interest reduces stockholders' equity. So we'll see it listed with a negative amount on the stockholders' equity section. Okay, that concludes our discussion of the balance sheet. The next topic for the semester is going to be the statement of cash flows, and that will be in a separate video. Please be sure to be very familiar with these notes, have them available with you in class, maybe print them out, and it wouldn't hurt to sleep with them next to your pillow so that you can see them at the end of every day and first thing every morning.